Greetings, friends. My name is Weston Nakamura from Blockworks Macro in Tokyo. It is Friday, July 7th, 2023. After Asia markets close, welcome to the Market Depth Podcast, bringing you global market commentary and analysis from the Asia Pacific trading session so that you know what happened overnight. We have a very special guest segment for today's episode. We have Michael Howell of Crossborder Capital on, and he'll be on in just a minute. And if you've been following Blockworks Macro, you likely already know him, and you know the kind of brilliant work that he does and his very specific framework of looking at financial markets through the lens of flows of capital and liquidity, and that process that he's been perfecting for decades, right? And if you've never seen him before, well, you can see any one of his appearances on Blockworks, either on Forward Guidance with Jack Farley, on the Margin with Mike Ablito, or the whatever they call that mashup, the mashup show with the two of them and Michael Howell. Now, with that said, before we start, just want to give you all a kind of a heads up. This is not going to be a typical Michael Howell interview, not that there is ever such a thing, because he always comes with something very new, but this is not an interview at all, per se, okay? Michael and I have had many on-air discussions in the past, as well as regular contact off-air, as you'll see. We bring up conversations that we've previously had or ongoing discussions during today's talk, because we exchange our views and thoughts and insights and and questions. But more specifically, the purpose of me asking him to specifically be on the show for today is because I need to know what the liquidity picture out of China has looked like over the past week or two in context of my running thesis from the previous episode of Market Depth from the other day, right, on this sudden leadership shakeup that happened at the top of the PBOC, China Central Bank, and how, in my view, that leadership change has little to nothing to do with actual stimulus policy out of China, but more so, it's part of a broader effort currently underway by Chinese officials with one immediate and urgent priority focus: put a floor under the cliff-diving yuan as it approaches a very critical level of roughly 7.3 on dollar CNY. If you haven't seen or heard this episode yet, it is the latest one prior to this episode from July 6th, I believe. It's called What the Sudden Leadership Shakeup at the People's Bank of China is Really About. And I strongly suggest that you watch it because this discussion with Michael is a follow-up to that episode. And secondly, you just need to watch it because, frankly, nobody is talking about this leadership reshuffle at the PBOC at all, let alone in the context of the yuan, and they absolutely should be. And as I discussed in that episode, I, of course, have been closely following the PBOC, especially with things like their daily yuan fixings and their liquidity activity every morning. And indeed, the PBOC has been setting far stronger midpoint fixings on the yuan versus where estimates are almost every single day over the past 2 weeks, or the last 10 trading days or so. And in addition to that, I'm also watching the PBOC's liquidity injections that they also do via 7-day reverse repo operations, which, if you recall, they had just recently made an early surprise 10 basis point cut to the 7-day reverse repo rate recently. But kind of on a granular, more day-to-day level, the amount of the PBOC's liquidity injections into the banking system have been far surpassed by the amount of reverse repo that they're letting expire, okay? Which is a long way of saying the PBOC has been net draining liquidity from the markets every day this week, totaling to a little over 1.1 trillion yuan of net liquidity drained from the system this week, okay? And again, why would the PBOC drain liquidity instead of inject liquidity, net liquidity, into the system? And of all times now, because stimulus and easing measures are not where their priorities are in the immediate. Strengthening the yuan by any and all means is. Okay, so this is why I asked Crossborder Capital CEO Michael Howell, who is the king of monitoring and analyzing and understanding global liquidity and flows and their impact on financial markets, to connect with me to see if we can get some additional color on what he's seeing over at Crossborder Capital in terms of the liquidity activity out of China. Is China indeed net draining liquidity? If so, why? And just a side note before we get into this is being filmed as Janet Yellen is meeting right now with officials in Beijing. So maybe by the time like all this is over, maybe something would have blown up or achieved diplomatically, and dollar yuan makes a big move or not. Just so you all know, indeed, this is after Asian markets close. Okay, so with all that said, here's my talk with Michael Howell on the subject of Asia liquidity and dollar yuan as well as dollar yen as of late. Okay, Mr. Michael Howell from Crossborder Capital, welcome to the Market Depth Podcast.
Well, it's great to be here, Weston. Very good to see you.
Yeah, great to see you again. Thank you for joining me on such short notice. But we have had quite a week. I had this thesis basically put out regarding the leadership change that happened very under the radar purposely over the 4th of July weekend last weekend at the PBOC. And we have basically a new gentleman in who is very much an FX markets and yuan management, not just reputation but actual role. He's also the director of SAFE, which oversees 3 trillion in their FX reserves and all that. And so my thesis being that this leadership change that's going on at the PBOC is really little to nothing to do with actual China stimulus policy in and of itself, and rather it is part of a broader effort or measure in which there's one goal, and that is to stem the decline of the yuan. And then in his kind of sudden entrance into the picture is part of that broader effort. And then I'm also looking at things like PBOC daily midpoint yuan fixing every morning. And I mean, it's been quite incredible over the last, say, week or two, how much stronger they are purposely fixing the yuan versus estimates, sending a clear message. We are trying to stabilize the yuan. We want it stronger, yet the yuan keeps falling. And now we're near very, very dangerous levels of 7.3 on dollar CNY. Because if it breaks through that, that's a new 15-year low on the yuan. So, I'm watching daily fixings stronger, and I'm watching, net liquidity drainings happening. And then this week so far, it's basically been about a little bit over $1 trillion RMB worth of liquidity that has been drained from the system, which is not at all easing. And my view is that that's all in an effort, part of this broader singular effort to just maintain the stability of the yuan. And so I wanted to connect with you and see what you're seeing on your end from your empirical end, and see if it aligns or not. But what are you seeing? Are you seeing anything at all in terms of change in trend of net liquidity injections versus draining and all that over the last, say, 1 to 2 weeks?
Yes, I mean, I agree with you 100% and more. What's going on here is clearly a refocus on currency and trying to stabilize the yuan. The yuan is fundamentally a weak currency. I think we've established that, over the past few months or even years. My view is that it's in, I'm not going to say terminal decline, but it's in trend decline. The yuan US dollar cross at some stage will have a 10 in front of it. That's how worrisome the situation is. In a way, China's only route to growth now is basically through exports. They need to get export growth up. They need to get the yuan down in time. What they cannot afford to do is to see this as panic. What central bankers don't mind is weaker currencies in the medium term. What they absolutely hate is loss of control in the short term. Currency volatility, currency spikes down or even up are very unwelcome. So what you're seeing here is a gathering of forces in China to try and control or stem this slide in the yuan. As you correctly say, there's been efforts in this last week to take about 1.2 trillion yuan out of the money markets. China historically has a record of trying to control forex movements in the short term by using short-term daily market operations. They've done that in size through this week. To put this in context, this is a dramatic reversal of what they were doing only 10 days ago, when they actually injected about 1 trillion yuan into the money markets to try and goose the economy and get growth going up faster. That has now been hastily reversed. In other words, the economic priority now is to stabilize the currency, not to deliver growth in the very short term. I think this is very important. Now, I think you can go wider than that, and you can say, well, what is going on in context? Because there's no unrelated events in financial markets. And I would point to 2 things. One is a thesis I've had for well over 18 months now, which is basically saying that it's not really the dollar that's being weaponized, it's the yen that's been weaponized. And the yen is being weaponized against the Chinese yuan. The scale of yen devaluation just over a year ago, about 15 months ago, from March of 2022, was unprecedented. In 30 years or more in financial markets, I've never seen a major cross devalue at the speed the yen did at that time. Markets don't do that, only governments do. The yen was a stalking horse, and it was trying to put pressure then, a year or more ago, on China. That was ultimately successful. It forced the yuan to devalue through 7. That was, back fall of last year. That was a successful policy. Effectively, what's happening is that's happening again. The consensus trade at the beginning of 2023 was that the yen was going to be strong. Ueda was going to come in and reverse the YCC policy, and that clearly has been wrong. Japanese policy continues to be easy. The yen is weakening substantially. That weakness in the yen has put a lot of pressure on China, and Chinese yuan has consequently weakened as well. Do not also rule out the fact that this week we've got Treasury Secretary Yellen in China. These are not coincidences, in my view. There was a lot of pressure being put on China, and effectively the US is holding a deck of cards with a lot of trumps in it. And basically they're going to try and use those to get some deal, in my view. Now, that may be left field. It may be crazy, but I think that that's what's going on in markets. Watch the currencies closely. And if I'm correct, what we're likely to see in the next few months is some weakness in the US dollar and some rally in the yen and pressure off the yuan. But there's been a sulla tabla deal done to get that. What that is, we'll never know.
Okay. I don't think you're crazy, first of all. Second of all, yeah, I remember having that conversation with you regarding the yen. So let's get to that in a minute. But let me just rewind from what because you just put out a ton of gold there. You said that about 10 days ago, from according to your metrics, when you start seeing a kind of shift in terms of specifically just the PBOC and their liquidity injections. 10 days ago is what, the 26th of June, and that is when you started seeing these very massive gaps, 100, 200, 300 pip gaps in the daily yuan fixing midpoint range, and how much stronger the actual fixing is. And so, almost out to the day in which this is like a concerted effort. So that's very interesting that's what you're seeing. And indeed, so right now, the point being that I also said this too, that the reason that they're dragging their feet almost on this stimulus that is so needed is because they cannot do that, because if they stimulate that, it's going to weaken the yuan, and that is antithetical to their immediate term priority, which is to stabilize the yuan at these very critical levels. So thank you for that. So Michael, let's talk about the yen for a moment, as long as you bring it up. So you say that they actually are very much interconnected. So first of all, you have the yuan and the yen. Yeah, they're both getting crushed versus USD. But fundamentally, the story and the picture seems that, well, that would make sense, because these are the two economies that are going in opposite monetary policy directions. What one is on autopilot easing, the other one is now actively going to be easing, or perceived to be, in the face of a tightening global monetary policy sort of environment. And so therefore those two should be getting crushed. But what you're saying is that there's something more deep than that, and that there's an actual concerted effort in order to inflict pain upon CNY.
Correct. I take it from the standpoint that says capital flows drive currencies. And the question is, who is controlling those capital flows? It's not necessarily just interest rate differentials. I tend to believe that interest rate differentials follow currency movements and capital flow movements. They're derivative. They're not leading. And I think there's a lot of evidence to back that statement up. But it's all about capital flows and the question of monitoring those capital flows. And as far as I can see, what we've got at the moment is an engineered decline in the yen. Now, that may be, as I say, left field, and it may be wrong, but that's how I see things. And I think the coincidence is one must draw here. There's no unrelated event in macro, and what we're looking at is a weaker yen. We're looking at a weaker yuan, and we're looking at an impending visit of the Treasury Secretary to China. And I think all these things are connected in a similar way to the fact that they were connected last year, where China basically was its feet were held to the fire by a very weak yen and by a lot of pressure being put on from the US. Now, I think that those things are unconnected. China has basically found it extremely difficult to ease monetary policy over the last, in fact, 18 months because of pressure on the yuan. As I said right up front, I think the yuan is fundamentally a weak currency. It has to devalue, and it probably has to devalue in size. But what the authorities in China are trying to preserve is some integrity in the short term, and to make sure that currency doesn't free fall, on a daily basis. They need to get some stability back, and that's why monetary policy is tightening right now. Now, coming out of this, let's remember that there's been a lot of subtle and somewhat surreptitious central bank interventions in currency markets in recent years. Going back to 2016, there was the so-called Shanghai Accord, which then attempted to get the US dollar down. That was not well publicized, but it's now, I think, been an accepted policy that happened. And what I'm suggesting is there may be similar attempts now, and there is an acknowledgement, perhaps, or there will be an acknowledgement that the US dollar needs to come down. And that's what I would start to expect to see in markets. Now, if I'm correct, coming out of this weekend or out of these talks, what you're likely to see over the coming weeks is less pressure on the yen, downward pressure on the yen, on the yuan, and basically some downward pressure on the US dollar. And that's how I think things are going to pan out. If the dollar begins to weaken, that is a significant positive for global financial markets, in terms of risk-on trades. That's what I would expect to see over coming months. And I think going into 2024, markets will be strong. I still believe that the liquidity cycle globally has bottomed. That occurred last October. We're an uptrend. That liquidity uptrend is being fueled partly by the US, to a large extent by Japan right now, and by the fact that if you look at bond markets globally, apart from this near-term sell-off, generally speaking, from late last year, bond volatility was coming down, which basically enhances the value of collateral in lending markets. So all these factors are coming together.
Right, and so let me just ask you, actually, just mechanically. So when you say that, so how exactly would a weakening yen mechanically influence a weakening CNY or CNH? Is it just because a weakening yen strengthens the dollar, therefore dollar strengthening against other currencies, including the yuan? Is it basically as simple as that? Or
I think it's just basically looking at trade relationships. I mean, what we've got is a regional economy in Asia that is very tightly integrated, and you can't see significant changes in currency crosses. And what you're seeing is a lot of pressure being put because the Japanese yen versus the CNY has been weakening quite noticeably, and that can't go on. So I think that a lot of this, in terms of the pressure that you're seeing in markets, is stemming from the fact that what you need is a stable currency block. If you've got economies that are increasingly integrated, that's very important. And in my view, that's the thing to watch. So we've got to start looking very closely again at forex markets, where I think that's sort of somewhat gone into the shadows in recent weeks. But I think they've got to come back. The dollar is absolutely paramount. My view, as you probably heard before, is that the dollar remains in what I've termed a Bretton Woods one regime. It's all about the dominance of the dollar. Any consideration that other currencies are going to challenge the dollar is fanciful, and the dollar is now sort of muscling around.
A filthy, filthy shirt, but still the least filthy, as you've put it many ways.
It's the cleanest shirt in the laundry.
Yeah, indeed. And so when you and I talked about this last year, you talked about weaponizing the yen, and at that time, if I recall, you had said that the U.S. and Japan succeeded in devaluing the yuan through 7, and they got that done. Well, we're back through 7, well through 7. So this is basically kind of mission accomplished, and this is why you're saying that around now is when they'll kind of take the foot off the neck of the yuan, or do they want to see it continue? Because they probably wouldn't want to see a runaway downside to the yuan as well, and disorderly. But now that we're at critical levels simultaneously on both USD CNY, CNH and USD JPY, you have USD JPY back at 145, which is where intervention 1 of 2 happened, and you have CNY at that critical 7.3-ish, nearing that level of breaking out to that 15-year low simultaneously happening. Was that where you're kind of getting those levels at, or?
Yeah, I think we're close to the lows, and have they achieved their goal? Well, I think we'll see after this weekend, because I think there is, as I've been suggesting, there's another agenda going on here. That the US is trying to use its geopolitical power via the dollar to actually influence relationships with China. So we'll see what comes out, if there's any communique. But ultimately, what I would tend to look at is the path of the dollar, maybe dollar yen as a proxy over the course of the next few weeks. And if I'm correct, we're somewhat close to the end of this weakness in the yen. We'll see generally the US dollar begin to soften. That's not to say that the dollar is in a long-term bear market. It certainly isn't. I think it's in a longer-term bull market. But I still believe that what you're likely to see this year is some adjustment down in the dollar from what we've had is 2 years of strength, at least 2 years of strength, and there needs to be some pause in that. And I think that respite in the dollar will be a significant fillip for global liquidity in markets come later this year. And I'm still in the view that we're in a new bull market. I think that started late last year. I think everything lines up that way. I'm not discounting the fact there may be a recession, but ultimately the question to ask is, why are markets going up? And in my view, they're going up for this is risk markets. They're going up because the liquidity cycle has turned higher, and there's lots of compelling evidence for that. Doesn't mean to say it's going to go in a straight line. Make no mistake. There could be reversals en route, but the general trend is upwards. And the second thing, the key thing, which I think everyone is underestimating, is that inflation is coming down. And stock markets in particular are valued against inflation more than anything else. That's absolutely critical. It's incorrect to say, as we've shown many times in our research, that bond markets matter for equities. What really matters is the inflation backdrop. And if inflation's coming down, which it is, stock markets are going to get a fillip. Now, if you start to look at China is a major input into global inflation and US inflation. China is starting to see renewed deflationary pressures now, and that is likely to translate into lower cost inflation in 2024 worldwide. And so what you're seeing is some significant gains, I think, in terms of the battle against inflation. And that is important for stock markets. Not to say that you won't get renewed inflation in the future. That's obviously a concern. And that's one of the concerns we've raised many times. But that comes back to a very different issue, which is the fiscal integrity of global governments. And with aging populations, this is a big, big issue that everyone needs to tackle. Monetary inflation is coming back big time, but that's in the future, not now.
Yeah, and you and I, our views align on that. Yield curve control, whatever you want to call it, however you want to market and package it, yield curve control in some form, in some way, it has to be in place.
It's happening.
You cannot have government.
The fact that the Treasury has got very closely involved with debt issuance, and in particular targeting the money funds with bill issuance, is basically telling you they're concerned about the liquidity background. If they're skewing US debt issuance heavily towards bills, and they're marketing those bills directly at the money funds with an attempt to get the reverse repo pulled down in size, that in a way is a form of yield curve control. That's what they're trying to do.
Indeed. So there's that, and then there's also very much the potential of, and we only see it upon it happening, but if you just get into a UK gilt situation, you're going to see the central bank step in and conduct emergency yield curve control, directly purchasing the long end of the U.S. Treasury curve or whatever sovereign curve is blowing up, because they have to. For the sake of stability, right. They're going to try to say, it's for the sake of stability, and they'll be correct. It's going to be a very hard sell to do so. This is not QE. That always does exist. Just because it hasn't happened yet doesn't mean that, should it happen, that's what the reaction will be. And the UK was a very clear example of that. And it also, therefore, gives central banks like the Bank of Japan, it justifies, this is why we must have yield curve control in the first place, because look at what the UK had to do. So it's a good thing we already have that measure in place. This is preventative, that was reactive. This is why we need to do that. Also, let me just ask you, because I also did a recent episode about Governor Ueda, who, by the way, I know that you and I talked about this. You had encountered him like a long time ago, back in the day, I guess, when he was a policymaker, several years ago.
Yeah, but it was probably more than 20. I mean, 25 years ago.
Yeah. First of all, do you remember him having any sense of humor at all and telling jokes, or no?
I'm trying to remember. Not really. No.
Uh,
Yeah.
yeah. Okay. I did a whole entire episode on him because he was recently on stage just last week within reaching distance of Fed Chair Powell, Andrew Bailey from the Bank of England, as well as Christine Lagarde in Sintra. So those four major central banks. He stole the show. He's cracking jokes and all that kind of thing. He's talking. He's openly talking about other central banks' policies. You know, the moderator, who Sarah Eisen, who I think I have a massive amount of respect for asking questions, asking him like, "Do you think the other three central banks are tightening too much?" And he's answering questions. He's commenting on other central bank policies and all that. But when it came to questions of his own balance sheet, his own policies, it was that's a matter of the government. I have nothing to say. All that kind of thing, right? So
Right.
him being so outspoken at that time, it highlighted not what he was being outspoken about, but it highlighted what he was being very quiet about, which is the fact that there is going to be kind of almost like permanent yield curve control. But my stance was that, he actually might have had this level of kind of looseness and confidence subconsciously, because what the Bank of Japan doing is it is the last bastion of QE in the world, and he knows that the other central banks are counting on the Bank of Japan to hold down kind of global yields with yield curve control, pushing trillions of Japanese capital overseas into other sovereign bond markets so that they can be necessarily hawkish in their own economies. And should the Bank of Japan lift, then that could potentially hamper their, how hawkish they need to be in order for them to respectively tackle inflation and all that. What are your thoughts on that?
I think there could be something in that. I mean, I'm not. I must admit, I haven't got a strong view about that. I mean, what I would say is that bond markets are not in a great place right now. I mean, our view through this year has been to be very cautious of the long end of the bond market. I know there's been the other consensus trade has really been to for people to pile into long dated bonds, because many investors expect central banks to be forced to slash rates because of a slowing economy. That may or may not be the case, but the reality is that term premia, particularly on the big sovereign markets, are hugely negative. And this is the sort of so-called dog that didn't bark in the famous Sherlock Holmes story, if you're familiar with those. I mean, this is the big issue out there that investors and policymakers are just not confronting. Why are term premia so negative? And why are term premia, particularly on the pristine collateral markets like the Bund and the US Treasury, the most negative of the lot? And it suggests that there's a shortage of collateral in the system. And that is a major, major concern, because it says there is underlying fragility in the system, which really means that central banks have got to be on the alert 100% of the time. And that's why I don't think QE goes away. It's got to come back every time there's a problem. And there will be problems. The more that central banks try and withdraw liquidity, they'll find they can't.
Right, because a negative term premium makes no economic sense. So there has to be some sort of other reason, and it has to be and therefore it's structural. Is what you're saying, right?
Yeah, exactly. I mean,
Yeah.
it's if you look at the data published on a daily basis on the New York Fed website, what you've got a term premia at their most negative ever in history, and this history goes back to the 1960s, early 60s. I mean, this is very, very significant. The fact you can have such a negative term premia at what is the most important financial asset in the world, the 10-year US Treasury bond.
Yeah, indeed. You talked about the kind of inflation dynamic and China and their exporting of inflation and or deflation, I suppose, right? There's a kind of a thesis that I've been kind of mulling around in my head that I've yet to present, but I guess I'll just do it here. But this thought of Chinese capital flight. Okay, so Yuan's getting crushed, right? Capital flight. Of course, there's capital controls within China, but there are ways to get around it, especially for the wealthy to get around it. And so when people say like, why are things like U.S. home builders rallying and all that, and why is there so much strength in that? And then you look at things like the RBA having to shock hike rates, the Bank of Canada having to shock hike rates. Well, my thought might be that you're seeing capital flight out of China going into things like property in those areas, and therefore China economic weakness, as reflected by a weakening yuan, is actually inflationary and not the other way around in certain asset classes or certain assets in these developed markets because there is a flow out of China by the wealthy Chinese into Australian housing, Canadian housing, Vancouver, whatever, and in the United States as well. Therefore, you get. I mean, I have a chart basically of the XHB S&P Home Builders Index as well as Hang Seng Property Index, which is on a downward hill, and they actually have a mirror kind of split, like long short perfect pair almost. Any thoughts on that at all? That Chinese weakness, decline in the yuan, and all that is leading to, strength in housing and therefore in kind of inflation as well in those markets.
I think it sounds to me entirely plausible. I think that's right. I think that what that tells you is there's a great need for the Chinese authorities to try and stimulate the economy in some form to get growth up and get returns on capital higher. That is clearly a challenge. As there's a joke in Ireland which says if you want to travel to Dublin, let's not start from here or don't start from here. So they're in a bad place. Okay, but they've got to try and go forward. What choice do they have? They've really only got two choices, as far as I can see, because they're not going to change the underlying backdrop of consumer spending. They can't, given the communist system. It's very difficult to enfranchise a consumer, as we know. So they've got to go down the infrastructure route. Well, good luck with that. There's been too much of it. There's been overbuilding, as we know. But they are starting to relax some of the constraints they've put on there. The Belt and Road Initiative, well, I think people have kind of wise to that now, but notwithstanding, there could be something going on, which really leaves the export route. So China has to try and find a way of exporting into the world. And that's why, I tend to think in the medium term, all the talk about decoupling from China is maybe overblown in the sense that, we are in a global world. Capitalism likes globalization. It's going to reinvent itself somehow, and there will be some rapprochement between the US and China, and China will bide its time. At the end of the day, what they want to do is to preserve the regime beyond anything else, and another 5 years will be good. And what they need is, above everything else, as we all know, and you know as well, they need growth. They've got to get growth. You can't have youth unemployment levels at these levels for very long. We know that. So they have to buy growth. And whether that's allowing the yuan to devalue, by itself, or having some tacit agreement with the US that things are, the dollar weakens and they can ease monetary policy simultaneously, I don't know. But I think there's a deal coming.
I think that Chinese everybody gets that because of the decouple, not de-risk thing that has started to emerge recently. Because there is no decoupling, so they just kind of reach the de-risk. So let's finish up on the current news so Janet Yellen's currently in China right now, and they have a ton to discuss. Obviously the currency is going to come up. Whether it's going to be talked about in a communique publicly or all that, I don't know, and I seriously doubt that it would.
Unlikely,
highly unlikely. Unless it's purposely planned to be, but unlikely. So she's there for 3 days or something like that. It's a long trip from Washington, D.C. to Beijing. It's a very, very long trip. If Janet Yellen's plane, if it stops over in Tokyo, that would not surprise me if that headline just sort of popped up in the next coming days or something. And then if it doesn't, it also is very telling about how the U.S. currently feels about the dollar yen at 145 and beyond, that they may or may not care. But do you think that might be something to look for, a potential Tokyo stopover and or a Tokyo snub?
Well, I wouldn't necessarily put it in terms of a snub. I think the thing is that my view is that the US and Japan are working pretty closely together here. I also think that the Federal Reserve and the Treasury are working pretty closely together. So I think there is a sort of united front going on. And in many ways, I mean, Yellen is the most important person in the administration. I mean, she's the most articulate. She's certainly the one who is able to travel and communicate the views, articulate the views clearly. So, let's listen to what she says and let's look at what she does. I think it's critical. But I come back to the point, what traders and investors need to look at the next few days is really the path of the US dollar. That's going to be key. And I think that my expectation is you're going to start to see in the next few weeks signs of a weaker dollar. And I think that will almost cement the fact or confirm the fact that there is a deal, a sur la table deal, which has been done here.
And so, therefore, look at the U.S. dollar. You mean the U.S. dollar JPY cross to lead the USD CNY cross?
Yeah, or DXY or whatever it may be. But I think that we're in a situation where dollar strength cannot go on. And my very simple view of markets has been to say that 2022 was all about getting the US dollar up and the Fed balance sheet down. And I think, or the effective part of the balance sheet down, liquidity, in other words. And I think that this year is all about getting the dollar down a bit and getting the effective balance sheet, in other words, liquidity, up. And I think we're getting that playing out.
Indeed. Well, look, Michael, I know you have to run. Thank you so much for your time. Thank you for appearing on Market Depth. Let's have you back on, when you get a chance, or when markets blow up, and one of those two will happen probably sooner than later. But Michael Howell from Crossborder Capital, where can they find you? What's your Twitter handle again, for the audience?
At Crossborder Cap, there is a Substack called Capital Wars. There's also a book called Capital
book
Wars.
called, yeah, I was going to say there's that too.
Our website is crossbordercapital.com. So we're available everywhere. But anyway, thanks again, Weston.
And you
also
publish on Smart Karma a lot too, right? Is that we different things too?
We do bits and pieces on Smart Karma, but the main engines are the Twitter feed, the website, and Substack.
Michael Howell, you are a gem. You are invaluable to our processes. Thank you so much for your time today.
Great, Weston. Thanks.